Welcome to the Private Practice Survival Guide podcast with your host, Brandon Seigel. I'm a published author, speaker, entrepreneur, and private practice strategist dedicated to transforming the way that healthcare functions. This podcast is all about empowering you to create the change you want to see. Let's dive in. Welcome back to the Private Practice Survival Guide podcast. In our quick tip episode today, we are talking about the difference between cash basis analysis and accrual basis analysis. Now, I know you're probably like, oh, Brandon, I am not up for this, but I promise you, I want to make this as simplistic as possible. And I really want to break it down in a way where you understand what we're trying to achieve, because I want to make sure you notice that the topic is from an analytical standpoint, analysis. So I'm going to use that word again, cash basis analysis versus accrual basis analysis. And I know this goes into what's called cash basis accounting versus accrual basis accounting. I'm not here to tell you how to do your accounting. Your CPA will do your accounting. But in healthcare, these two strategies, I'm going to call them strategies, are so critical. And we don't recognize that we need to look at both of them. And so we typically in healthcare run our accounting on a cash basis because of taxes. And cash basis is basically money in, money out. So, hey, Brandon, I performed $1 million of revenue, meaning I collected, let me rephrase that. I collected $1 million of revenue in 2024. I spent $1 million in expense and I had nothing left over. So on a cash basis, we had $1 million of revenue collected. We had $1 million of expense spent, and we therefore had a zero profit year on a cash basis. So when we submit to the IRS, it would show zero, basically, net profit. But now I'm going to convert this to an accrual basis. Let's say we collected $1 million in revenue and we spent $1 million, but we actually performed $2 million worth of services, in which that additional $1 million is going to land in 2025 on our collectible line item. Well, then on an accrual basis, we did a $2 million of revenue. And let's just say that on an accrual basis, expenses are cash basis. So let's just say it was $1 million expense for that $2 million delivery. Then maybe it really is a $1 million accrual base net profit. And I know that's really challenging to think with, but what I basically want you to think with is money in versus money out is cash basis. Accrual basis is the value of what was generated versus the cost connected to deliver those services. So in healthcare, I'm going to spend $10,000, let's say this month, to deliver all these services. But I'm not getting paid today on all of these services. Maybe I only get paid 30% at the time of visit. So 70% of that money is not being collected and won't hit my cash basis this month. So we want to run both. And I think that's really critical. So tax-wise, I like cash basis. Accrual basis is a strategy standpoint. And I think, I recently was meeting with a client, and they said, I get paid $150 an hour for what I do. And I looked at everything they did last month, and I said, you didn't collect $150 last month. And they said, yeah, but I'm going to get $150. So on a cash basis, they average $55 just based on the way that cash comes in. So they have to understand that even though the value of that service is higher, there's a delay in that cash. And I think one of the things we have to recognize is that When we're running an accrual-based business, we need to have more line of credit because cash flow can catch up with us. It can go either way, but let's just say you're hiring a lot of people. Well, you're eating your cash flow as you're hiring, and it's going to often take 90 days for that cash to kick in. So whenever we hire an employee, we have to have enough runway to understand that. And so I like to hire an employee and have 6 months of reserve, knowing that I should be 90% in that 90-day period. But again, under promise, over deliver. And so I think it is critical that we look at, why do we do cash basis? Because that's how taxes are seen. How much money are we paying taxes on? We're paying taxes on money collected versus money paid out. We're not paying taxes on what could be. The other problem with accrual basis is sometimes you don't end up collecting money. So you got to be careful that, does the accrual basis and cash basis line up within a period of time? What's that loss leader? So you see a patient and they tell you that they have Blue Cross. And let's just say you bill Blue Cross, and let's say Blue Cross pays you. And let's say 3 months goes by, and then Blue Cross takes that money back. They say, we paid you by accident. Blue Cross wasn't the primary, and it's UHC. But now UHC says, sorry, we're not going to pay you. Timely filing, you missed out. Are you going to eat that money? How does that look? All of a sudden, that's going to affect both your cash basis and your accrual basis. Why do we look at accrual basis? That's probably one of your questions. Why? Why do we look at accrual? Well, we look at accrual because you need to understand what the ideal margin could be. So I am contracted at $350 for the service. It may take me 3 months to get paid, but I know that if everything goes as planned, I have $350 that I can plan for in revenue. And so that allows me to also break down the expense, how much I'm willing to take because of that. So maybe you say, hey, I pay my employees more because I get paid quicker, or I pay my employees less because it takes longer to get paid. These are all factors that we look at, but we help determine that based on both our cash basis as well as our accrual basis. I have found it hard to run taxes on an accrual basis in healthcare. There are CPAs that do it, but I do tend to run a cash basis. So even sometimes here's another thing to think about though. Sometimes you'll do something and you'll collect cash ahead of time, but then you'll want to post it in that new year. So maybe you say, hey, we received this money, but it's connected to next year's service or something to that extent. But I can't go the other way around. I'm not going to count money that I'm going to collect in 2025 and 2024. So we really do have to measure kind of where we're at with all of that. I typically am running quarterly analysis. And in that quarterly analysis, what I'm going to do is I'm going to run a profit and loss. I'm going to run an expense ratio. And I'm going to look at what the expense ratio is to cash and what the expense ratio is to accrual. And I'm going to compare the differential. And then I'm going to also do a look back period of 6 months. And I'm going to show what is the value of accrual to cash in ratio. How much of what we projected our revenue to be on an accrual basis became an actuality in that 6-month trend or in that 4-month trend. So maybe in Q2, you're evaluating Q1 numbers in that sense. And sometimes what we need to do is we need to run the analysis from our EMR, where we actually run date of service, revenue charges versus accrued value versus collected value. And those three, what I call trigger points, are how we can measure the effectiveness of our collections. So we are measuring the value of our charges, what we are inflating. Then we're measuring the value of what we received in cash. And then we're measuring the value of what I'm calling the accrual, which is your contracted rate, what we should be receiving. And if those line up, typically our charges are 25% above our highest reimbursing insurance, just so we know. So as we look at the difference between cash basis analysis and accrual basis analysis, cash basis is us being able to cover our bills. Honestly, that's what I look at. Accrual basis is, do we have the meat on the bone? Is the margin there? And then at what point do they intersect in your business? Is it 90 days out? Is it 180 days out? And is there a differential? Do we have a loss leader? Is there a percentage of revenue that never comes in? Those are all things I want you to be tracking. So I have the statistic of the episode for you. The statistic of the episode that I want to bring to you comes straight from Harvard Business Review. Harvard Business Review says companies using accrual accounting are 2.5 times more likely to secure business loans and investor funding compared to those using cash accounting. Whoa. Companies using accrual accounting are 2.5 times more likely to secure business loans and investor funding compared to those using cash accounting. Very interesting. And it probably comes down to they want to see the meat on the bone. They want to see what's real potentially coming in, what the value of that service is, not just cash flow. So we look at things differently. I think it is harder when we look at healthcare and accrual accounting, but it is possible. It just takes having the right team, the right resources, the right structure in place, the right data analytics to pull from. So as we look to the end of this episode, I want to leave you with our motivational quote, and it comes from Warren Buffett. And this quote is truly all I should have shared for the whole episode. It is so perfect. So Warren Buffett says, understanding the difference between cash and accrual accounting is like knowing the difference between your bank balance and your actual financial health. And I'm going to say that again because this really could not sum it up any better. Understanding the difference between cash and accrual accounting is like knowing the difference between your bank balance and your actual financial health. Thank you so much for tuning in to this episode of the Private Practice Survival Guide podcast Quick Tips. I hope that you'll press like, you'll subscribe, you'll share it with all your friends, you'll watch it on YouTube, you'll replay it, you'll comment, and you'll reach out to me. Again, I care so much. Together, we can thrive, not just survive. Thank you again for tuning in to the Private Practice Survival Guide. Thank you for tuning in to the Private Practice Survival Guide podcast. I'm incredibly grateful to each and every one of you. Exciting news. We're now available everywhere, from Spotify to Apple Podcasts to YouTube or anywhere you like to listen to your podcasts. So watch, listen, and reach out. If you love this episode, please drop a 5-star review. It truly means the world to me. Are you looking for more ways to elevate your practice? If so, now is your chance. Reach out, go to my website, or email me at brandon@wellnessworksmp.com. And remember, it's not just about surviving, it's about thriving.